simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally, and we do that by buying treasury bills. That actually increases the money supply.
Financial Turmoil Explained.
Good day, ladies and gentlemen. Welcome to this Mother's Day show on the 8th of May, 2022. Thank you for tuning in. I'm glad to have you guys here. You know, maybe in the comments section, you guys can make a little statement about your mothers. Good statements, okay? About your mothers, you know. And you know your mother is the one who really cares for you when you're young, growing up. Always has your back is your mother, you know. And wonderful. Thank goodness for all the sweet, nice, kind mothers out there in the country. And make a little statement maybe if you want in the comment section. I'd enjoy hearing about it. Anyway, we're going to move on with our show. We are all in an extreme amount of danger from something that not many people are seeing, but I'm seeing it here, and it's definitely coming. It's one of those situations where you're not going to escape it. It's math. It's baked into the cards now at this point. And we've heard a lot of talk about a reset, and this has an awful lot to do with the reset. In fact, this is the reset that's coming. And it's not going to be what people think. And I'm going to go into depth. I'm going to explain what the reset's going to be. It's going to be a reset into hyperinflation. But here's how it's going to be staged out. You all know what the Fed's doing. I've pointed it out on my channel many times. The Fed is being tight with money, with monetary policy, and being very tight all the way around with the financial system. And they've been raising rates. They raised 1/4 basis point, and now they've raised 1/2 basis point, and they're planning more basis point rate hikes. This is raising the cost to borrow, raising the cost of money. And what this does is it puts an extreme damper on the economy. If you picture the economy like a wood stove, probably all of you have operated a wood stove at one point in your life, you know. And the modern wood stoves they have now, you know, they have a thing on them called a damper, you know, you can shut it, and they're airtight. They're airtight wood stoves. They can quite literally, if they're working properly and you shut the damper on them, they can starve the fire so much for oxygen that the fire starts to go out. This is what's happening in the system right now. The financial system, all around the world, the central banks are tightening, and what they're doing is they're shutting the damper. The problem with this is when the fire goes out, it goes out suddenly. And this is where we're approaching. We're approaching a period in time where the credit markets are becoming unstable. They're going to keep going with this. They're going to keep pushing. They're going to keep raising rates higher and higher until they get the desired effect. And the desired effect for them is to stop inflation. This is what they're saying anyway. Now, I'm not sure if all that's true. They must know what I know. And what I know is the financial system's going to go into a sudden downturn, a very sharp downturn, caused by this. And we're already in the beginning stages of it right now. Now, you guys know on my channel for years, I've told you guys, put away $5 bills. In the United States, I'm talking about. Well, in Great Britain, you know, they still got a pound, Great British pound. Put away pounds for yourself. In money you can hold in your hand. Put some away for yourself. Pounds, British pounds. If you're in America, put away some dollars. If you're in Canada, put away $5 Canadian bills. If you're in Australia, do the same thing. All the countries around the earth that's listening to my channel, put some away for yourself. And the reason why is we're headed directly toward, right now, a credit freeze. You say to yourself, well, what does that mean, a credit freeze? It's just what it says. Interbank lending will stop suddenly, because what's going to happen is liquidity in the system right now is drying up at an alarming rate. The Brett Johnson milkshake theory is happening right now. Dollars are being drained out of the system. Dollars are needed, Dollars are not being created in absorbent amounts. Now, we had a number of years now when they were stimulating and doing monetary stimulus. And you'd say, well, why didn't we have hyperinflation during those years? And the reason why is because the amount of deflation out there was absorbing the amount that they were creating for the most part. And they finally hit a point with it where they started to create some inflation. Now they're coming down hard on this inflation. And they're going to evaporate all of the excess liquidity that they created during those years of plenty. They had to check the stove. Anyway, listen, guys. So what's going to happen is liquidity is going to drain out. They're pulling it away. And it's a no-brainer what's going to happen. They're going to keep going until they cause the effect. And the effect, I don't think, is really what they expect. It's going to be a freeze in the credit markets. It's coming up. I hear commentators on here talking about an 80% drop in the markets, 60% drop in the markets, 40% drop in the markets. Yeah, we're heading toward a big drop in the markets. But the credit freeze is going to happen before the markets can get down 60%. I'm estimating that the credit markets are going to freeze up well before the market gets down 60% down. The credit markets are going to freeze up. And so what is that all about? The credit markets freezing up. That's when interbank lending stops, and it's also when enough sufficient banks are going into insolvency. In other words, an awful lot of their loans that they have outstanding because the liquidity is drying up in the system could all of a sudden they can start to have non-performing loans and massive amounts of non-performing loans. Banks start to get in trouble. And see, to understand how this happens is, think about how a bank creates money. So, you got a bank and it runs according to what's called fractional reserve lending. And this is a magic little thing they have where they can create money in unlimited amounts and lend it out to people who want to borrow it. So, say Joe comes into the bank and he says, I've got this venture, I want to build an oil well. The bank goes out and checks it out, and they see it all looks on the up and up, so they lend Joe the money to build his oil well. $1 million they lend to Joe. Well, a lot of people think that the bank has to go back into a vault, get the $1 million, take the $1 million out of the vault, and give it to Joe. That's not how it works. How it works is they just write an entry, a book entry, into the bank, saying that Joe now owes $1 million to the bank. The bank just created that $1 million that didn't exist before. Now Joe goes out and he starts to do his work. He starts to hire people and he starts to build his oil well and stuff with that $1 million that just come out of nowhere. Now all's fine and good, provided that Joe is able to pay that money back with interest to the bank. But if something happens in the economy or whatever, so that Joe has to fire his employees, he has to send everybody home, he's used up half of that $1 million already, and he's got equipment that has to be sold at a fire sale or whatever because for some reason or another he went bankrupt. Now suddenly that becomes a non-performing loan on the bank's books because Joe can't pay them back. The bank can't get out of that, even though they created it just with a simple book entry, and they created that money from nothing. Now the bank is on the hook for that money that they created. The bank owes that money. It's an insolvency in their book of $1 million, and now they got a hole. The bank's got a money hole in their big problem because they cannot create money to fill that hole. The bank just can't go and create money to fill insolvency problems that they have. Even though they can create money from thin air, if somebody comes in for a loan, once they establish that money and they create it, now they're on the hook for it, and they have no way of actually plugging that hole. They just can't go and create more money to fill that hole. They just can't do that, the bank. So what do? Now they got a big problem. And they say, hey, we're going to go bankrupt. Our bank is going to go bankrupt because Joe wasn't able to perform on his loan, non-performing loan. Now, if they get thousands of those non-performing loans, suddenly the whole banking system is in trouble because that bank is connected to the bank next to it. And the bank next to it connected to the next bank. And they're all connected in together through these lines of credit. Okay? So when the stock market starts to go down, voluminous amounts of money are basically destroyed within the system. It just disappears. It's Fugazi. Disappears into nothingness. The banks are interconnected to the stock markets as well. This can create an insolvency problem within the banking system that can appear suddenly overnight. And how do they resolve it? Well, at that point, there is no real resolving it. There's a huge issue within the... This is called a meltdown within the system. It's a credit problem within the system between the banks. And, you know, the Fed then has to step in at that point, or the banking system could actually go under. And, you know, when we're losing tremendous amounts of money in the markets, this is reflected on the books of the banking system as well. I mean, the whole thing carries over. Also, the derivatives exposure. An awful lot of them are very sensitive, these derivatives, to interest rates. Things like interest rate swaps and things like that. They're sensitive to interest rates. So the whole thing could start to dissolve as it goes down, percentage-wise. Each time the markets go down a percentage, that's a percentage off of the wealth effect or the effect of supporting the financial system. The Fed knows what they're doing. They're withdrawing this liquidity out of the system at a massively fast rate right now, and they're going to cause an insolvency problem within the system. And we watch here on this channel the MOVE Index. The MOVE Index is an indicator. It's flashing red right now, the MOVE Index. For this problem, as the markets go down, it increases the amount of pressure for this problem to occur. The same problem that occurred back in 2008. Occur all over again, but this time with much more potential, much more speed, and much more aggressively. So it's like somebody that catches an infection, you know, maybe they catch strep throat. The first time they catch it, or maybe pneumonia. Maybe the first time they catch pneumonia, they don't get it that bad. But then they're prone to pneumonia after that. And that's what the system is like. It's had its big problem in 2008. Now it's prone to this again. And it's coming around because the Fed is acting as a trigger now for this to occur. So what we're going to have is we're going to have this insolvency issue. It's a meltdown within the system and the credit markets where the banks will not do interbank lending. So why do I say you need the $5 bills now? Now you need this money outside the system, cash. You're going to need it to make transactions when this situation occurs, and it's going to occur quickly when it happens. I think it's probably going to happen sometime this year, but maybe early next year. But it's going to happen because the Fed's going to keep pushing until it does happen. And so what's it going to look like to you on a personal level? It's very likely your debit card won't work. It's very likely that all the stores you go to will have a sign there saying, we only take cash today. It's very likely that your banks will be closed, and the only thing that will be open is your ATMs. And the problem is they'll probably put money into the ATMs once a day, and there'll be a big long line, and by the time you get there, there'll be no money left in the ATMs. This is probably what's going to happen. And you're going to have a very difficult time obtaining any cash. And people out there are not used to using cash anymore. They carry very little cash on them, maybe very little cash in the house. How are you going to purchase your food during this credit freeze? So the next question you're asking is, how long is this credit freeze going to last? Well, it could be as short as a weekend. If the Fed is quick about and realizes the situation they're facing, it could end in a weekend. But it could extend for a longer period of time. So you got to be prepared for it. Anyway, guys, listen. Wanted to give you guys a heads up on this situation. I got something burning on the stove. I got to go. Thank you guys for listening to my show. Like and subscribe. We'll catch you guys in the next episode. Bye-bye.